Question number 18 is about how could a private equity firm boost its return on a leverage buyout? So, if you have attended the previous lectures, so we have discussed about leverage buyout in detail. So, if we focus on private equity firms' return on a leverage buyout. So, in a leverage buyout, a private equity firm is looking to maximize its return on investment by optimizing various aspects of the transaction. While the ultimate goal is to increase the equity value at exit, there are several strategies, both theoretically and practically, that a private equity firm can use to enhance its returns. So let's walk through the primary ways a private equity firm can boost its return on a leverage buyout. So first they can do is they can lower the purchase price. So theoretically, the theoretical strategy here is that this is one of the simplest way to improve the return on a leverage buyout is by reducing the purchase price. This directly increases the equity portion of the deal as less capital is needed to buy the company. So the lower the portion, lower the purchase price, the better is the upside potential when the company is sold or refinanced. And practical consideration here is that in point number one is that in practice negotiating a a lower purchase price can be difficult, especially in competitive auctions. Buyers typically need to make more offers, more. I mean, they actually have to make their offer more attractive to the seller while still leaving a room for uh, upside potential. And furthermore, a lower purchase price may raise concern about potential operations or financial issues, which can be a red flag in a due diligence process. So what they can do is they can lower the purchase price, or what they can another option they would have would be to raise the exit multiple or the exit price. In theoretical strategy, the exit multiple price or the price at which the company is being sold or IPO'd plays a critical role in determining the return. So by raising the exit multiple, the private equity firm can achieve a higher exit price, which translates to a higher return on the equity. And practical consideration here is that to achieving a higher exit multiple depends on the various factors, which include market conditions, the company's growth trajectory, and the industry's outlook. In a bull market, high multiples may be more achievable, but in a downturn, exit multiples could compress. Hence, predicting and timing an exit is at an attractive multiple can be risky but rewarding strategy. The third option would be to increase the leverage. So one of the most effective ways to increase the returns on the leverage. So this is one of the most effective way to increase the leverage. By using more debt, the private equity fund can amplify its returns on the equity, and this is because the debt holders provide most of the capital, and any growth in the company's value disproportionately benefits the equity holder. And practically speaking, while increasing leverage increases the potential upside, it also increases the financial risk. So higher debt levels mean higher interest payments and increased likelihood of financial distress if the company's performance flatters. So a private equity firm needs to ensure that the company can service the debt while executing its strategy. And furthermore, there is a limit to how much debt the company can take on based on its cash flow and the risk profile of the transaction. And a rising debt and raising debt can also affect the company's ability to execute on operational improvements, as it may be constrained by the covenants tied to the debt. The fourth point would be to grow the revenue. So increase the company's growth rate. Increasing the growth rate of the company, whether through organic or via acquisition, directly impacts the company's value. A higher growth rate increases earnings, boosts the company's valuations, multiples, and ultimately leads to a higher exit price. Organic growth could involve expanding existing products, increasing market shares, or improving operational efficiency to drive top line revenue. And acquisition might pursue a buy and build strategy, acquiring smaller competitors to consolidate the market and achieve economies of scale, and thereby driving future growth and improving margins. Practically speaking, increasing growth is easier than said. Organic growth often requires significant capital investment, time, and effective execution of a growth strategy. And while acquisition introduces additional complexity, integration risk, and potential cultural challenges, acquiring other companies can also dilute returns if the acquired businesses do not perform as expected, or if the integration process leads to higher than expected costs. And the final way would be to increase the margins by reducing expenses. So, theoretically speaking, improving margins by either increasing revenue per unit or cutting cost can have a significant impact on the company's profitability. In a leverage buyout, the private equity firm may focus on cost cutting. Cost cutting measures such as restructuring operations, streamlining the supply chain, or renegotiating suppliers' contract to reduce the input costs, improving the operational leverage by scaling fixed cost over a larger revenue base. In practical consideration, cost cutting is often one of the first areas a private equity firm focuses on post acquisition, but the extent to which this is possible depend on the company's operational structure and its culture. So aggressive cost cuts can lead to employee morale issues, loss of key talent, and customer dissatisfaction if the cuts impact product quality or service levels. So furthermore, focusing too much on the short-term margin improvements can sometimes hurt long-term growth and sustainability. And to summarize, we can lower the purchase price, we can raise the exit multiple, we can increase the leverage, we can increase the company's growth rate, and we can also increase the margins uh, to boost our returns. And while all these strategies are theoretically possible in financial modeling, in a financial model, implementing them successfully is actually successfully in practice requires careful planning, market timing, and operational executions also. So the balance between risk and reward is critical to optimize returns in an LBO. I hope this was clear. So let's move to question number 19. So question number 19 is about the tax shield in an LBO. So in an LBO, one of the core concept or core financial benefit of using debt is to create a tax shield. So tax shield refers to the fact that interest expense on the debt is tax deductible, which reduces the company's taxable income and therefore lowers the amount of cash taxes it must pay. So how does the cash tax work? So if we talk about this, so when a company actually incurs an interest expense from the LBO debt, it can reduce the interest from its pre-tax income, and this reduces the company's taxable income, which lowers the actual cash taxes it needs to pay to the government. And reduction in taxes paid effectively increases the company's free cash flow, and because cash that would have gone to taxes can now be used to pay the debt more quickly or reinvest in operations. So, okay, so why does it matter in a LBO? So, tax shield actually amplifies your equity returns. And this is actually the main reason debt actually is used by private equity firm for. I mean, more debt means more interest, and this means larger tax shield and higher after cash flow, after tax cash flow, and higher cash flow means faster debt repayment down and greater value for equity holders at exit. But the tax shield like also has a limitation. So it provides, it's important to emphasize that while the tax shield is a benefit, it does not fully offset the impact of taking on debt. So the company still has to pay the interest on cash, which reduces the net income and cash flow relative to a free debt-free company. And the tax saving helps, but they only partially soften, actually soften the blow of the interest burden. And also If a company's earnings fall too low, it may lose the ability to use the tax shield because it does not have enough taxable income to offset. And some jurisdictions also place limits on how much interest can be deducted. Uh, Example, limits tied to EBITDA, which means the tax shield may not always be fully available. So, in summary, tax shield in a leverage buyout refers to the tax saving created by the deductibility of interest expenses. This actually reduces the taxable income and cash taxes, boosts the free cash flow, and helps accelerate debt repayment and ultimately increases equity return. However, while tax shield is valuable, it does not eliminate the financial burden of debt. The company's cash flow and net income are still very low. Uh, I mean, the company's cash flow and net income are still lower than they would be without leverage. So this is the meaning of a tax shield, and it also has its drawbacks. Okay, so let's move to next question. I hope this was clear. Question number 20. Question number 20 is an interesting question. So question number 20 is about dividend recapitalization. So a dividend recapitalization is a financial strategy where a company takes on additional debt to pay a special dividend to its equity holder. And typically the private equity firm that owns the company, they pay those dividends. And essentially, it is a way for the private equity firm to recoup some of its initial investments early, even before an exit event or a sale of an IPO. And how do a dividend recapitalization work? So dividend recapitalization has three steps. So first is the new debt issuance. Then they make the dividend payments. And the third point is that there are no operational changes. So in first step is that the company raises new debt. So either it could be either through a bond issuance or a bond bank loan. The second step would be the proceeds from the new debt are then used to pay the one-time dividend to the private equity firm or the company's equity holders. And unlike a traditional sale or exit, the company does not change ownership. The recapitalization is simply a way to extract cash from the business without selling it or existing in a traditional manner. So they are not exiting from the business, but what they have done is they have raised a new debt and they have used that new debt to pay dividends. So that's dividend recapitalization. So if in a traditional company, it would have been expensed out, but here they have capitalized the dividend. So this is dividend recapitalization. Imagine a private equity firm which owns a company and has invested 100 millions in equity. So the company is stable and generates good cash flow. So the private equity firm can decide to leverage the business further by taking on a $50 million loan in new debt. So the company then uses that $50 million in debt proceeds to pay a special $50 million dividend to the private equity firm. And as a result, the firms get back a portion of its original investment early on before IPO. And why do private equity firms actually use dividend recaps or recapitalization? So for return on investment, so one point would be return on investment, and another point would be cash flow and debt capacity. So dividend recapitalization actually allows a private equity firm to take out some of the equity invested in the business without selling the company, and this provides liquidity to the private equity firm, which can be used for further investments by reducing the effective equity stake in the business. And second point would be cash flow and debt capacity. So if the company has strong and stable cash flows and can handle additional debt, a dividend recapitalization allows the private equity firm to realize a return without waiting for a full exit. So the company's ongoing cash flows can cover the interest and principal payments on the new debt and enabling the private equity firm to recoup parts of its investments. And there are risks involved with this, and there are also criticisms that uh, there is in the it actually increases the leverage. That this the focus is short term. Reputation also get hampers, so there is a reputation issue, and there is an impact on the stakeholders also, other stakeholders also. So the company now has higher debt levels, which means higher interest payments and increase the financial risk after the dividend recapitalization. If a company's performance deteriorates or if the market conditions changes, this additional debt can put significant strain on the company. And while the private equity firms benefit in the short term, the long-term health of the company may be compromised if too much of the debt is taken on. So the company may become overly burdened by debt, limiting its ability to invest in growth opportunities or react to market changes. And also, dividend recapitalization have received criticism for being a mechanism where equity holders benefit at the expense of the company's future stability. And in some cases, the companies have actually used dividend recaps to generate cash for their owners, even when the business is struggling financially or when the long-term outlook is uncertain. And for stakeholders like employees, customers, and other investors, the fact that the company is taking on more debt to pay a dividend can signal financial instability. And it can also affect the company's ability to invest in its operations or pursue strategic investments. So, in summary, just to summarize everything, in a dividend recapitalization, a private equity firm or a PE firm or other equity holders uses debt to pay a special dividend to themselves, and typically this returns a part of their initial investment. While this strategy provides liquidity and capital return in the short term, it increases the company's leverage and financial risk, which can compromise long-term stability. And uh, dividend recaps are common in stable and mature companies with strong cash flow, but can sometimes face criticism for prioritizing short-term returns over the company's future growth. So, dividend recapitalization or dividend recaps. This was new, and I assume that you might have also heard this term for the very first time. See, leverage buyout is difficult to understand, and it is supposed to be difficult because uh, this is actually uh, the most difficult field of a finance vertical. So, if you are having difficulty, I would suggest you do your own research on these questions, and but at least invest some time. So, with that said, let's move to question number 21. Question number 21 is about why would a private equity firm choose to do a dividend recap on of one of its portfolio companies? So we have just discussed about dividend recap. So a private equity firm may choose to do a dividend recap for several strategic reasons, but the primary motivation is typically to boost returns on its investment. So first of all, it would realize a return on investment, partial exit. Second, leverage actually returns the return on the equity, and reducing equity investment mitigates risk, and also it accelerates value realization. So this means that the private equity firms are more under pressure to deliver strong returns on their investors within a relatively shorter time frame. So usually 4 to 7 years. So a dividend recap is a way to accelerate the return of capital without having to wait for a full exit event like an sale or an IPO. and it also actually have a positive debt and market conditions. It has a positive impact on the uh, debt and market conditions. So private equity firm might also choose a dividend recap when debt markets are favorable, meaning interest rates are low and lenders are willing to provide debt on attractive terms. And in such an event or such an environment, the cost of borrowing is lower and the firm can potentially achieve a higher return with less risk as the additional debt financing is cheaper. And there is no change in the ownership, even if after dividend recapitalization. So, unlike a traditional exit, where the private equity firm sells its stake to the third company, a dividend recap allows the firm to maintain control and ownership of the business. And this is beneficial if the firm believes that the company's future growth potential is significant and it can continue to enhance the company's value. So the private equity firm does not loses its equity position, so it can continue to benefit from the future upside, whether from continued operational improvements or acquisitions or later it from more profitable exit. They can return more. They can create a more benefit. They can create more benefit and strategic timings also. So a private equity firm might also choose to do a dividend recap when the company has reached a point where it is generating consistent cash flows and is in a strong financial position to handle additional debt. So the company's performance or the market's perception of the company's stability makes it a good time to raise debt on favorable terms to fund a dividend recap. Risks and considerations. If we talk about risk and consideration, yes, there is a risk of increased leverage and there is a long-term impact also. So, if the company has more debt, which means higher interest obligation and greater financial risk, if the company's cash flow declines, servicing the debt could become challenging. And by taking out dividend early, the private equity firm may be prioritizing short-term returns over the company's ability to reinvest it in its growth or operational improvements. And this could affect long-term value creation also, especially if a company's ability to service debt becomes strained. So, in summary, just to summarize everything, um, private equity firm would pursue a dividend recapitalization primarily to boost returns on its investment by increasing leverage and reducing its equity exposure, while still maintaining ownership of the company. So the strategy allows the firm to recover some of its initial investment early, generating liquidity and increasing the return on the equity. While this offers a quick return, it comes with risk, and particularly the increased debt burden on the company is the risk, one of those risks. However, if executed in favorable market conditions with financially healthy company, a dividend recap can be an effective way for a private equity firm to accelerate capital returns and improve overall portfolio performance. And this is why a private equity firm chooses to do a dividend recap on one of its portfolio companies. So, all right, so let's move to question number 22. Question number 22 would be our last question for this series, the leverage buyout basic questions. And after this, we will start with the advanced question and answers. And the advanced question and answers are much more difficult. So I would recommend you to go through all the previous readings before moving to the advanced questions. Advanced level questions are actually much more tricky and they are supposed to be much more tricky. Uh, and those questions are I mean, if the advanced question would be only applicable to you if you are interviewing for a private equity job, or if you have a lot of experience in LBO on your resume, or you really do want to know what are the in and outs of the LBO. So there would be a lot of overlapping between merger models and LBO models questions, because many of the elements in the merger models, like purchase price allocation and deferred tax assets and liabilities, and the creation of goodwill, work the same way in both models. So, uh, I mean, if you want to learn, if you are confused about those topics or those questions, I would suggest you to go to the section where we have discussed about the merger and acquisitions, the advanced series or the basic series also. There you can get everything clarified. So let's talk about dividend recap's impact on the three financial statements in an LBO. So question number 22. So dividend recapitalization has very specific impact on the financial statements because company raises new debt and immediately uses the proceeds to pay a special dividend to the private equity owners. And the transaction affects the balance sheet and the cash flow, but it has no impact on the income statement at the moment, at the moment of the recap. So in the income statement, the dividend has no immediate impact on the income statement. Uh, so because dividend is not an expense, so it does not affect revenue, operating income or net income. New debt raised also does not affect the net income, sorry, the income statement until future periods. When the company begins in incurring new interest expense related to the additional debt. So in the period of recapitalization itself, the income statement is unchanged. So the balance, okay, now let's talk about balance sheet. So balance sheet is impacted in two ways. First is that the debt increases, and the second is that the shareholders' equity decreases. So debt increases means that the company raises new debt. So liabilities increase by the amount of the new debt raised, and shareholders' equity decreases means that the special dividend is paid out to the private equity holders. So dividends reduce retained earnings, which reduces shareholders' equity by the same amount because the interest in debt is offset by the reduction in equity. So the total assets remain unchanged. Assuming the company raises the debt and pays the dividend immediately, so balance sheet has an effect, means that the share debt will increase, shareholders' equity will decrease, and cash has no net change because cash inflow is equal to cash outflow. So balance sheet stays balanced. And on the cash flow statement, if we think about it, if we are able to link those, if you still remember the Excel which we discussed initially, so dividend recaps only, it actually affects the financing section. So because there will be no changes in the operations or investing section because dividends and new debt do not affect operating income, and new capital expenditure or asset purchases uh, are only involved in investing. So when we talk about the cash flow from financing, so cash inflow, there will be an increase in new debt, and paying special dividend, there will be an outflow of debt, outflow of that cash. So there will be an inflow of money from new debt by issuing new debt, and there will be outflow of money from paying of special dividend. And these are two cash flow. So and also these two cash flows cancel these entries also get cancelled out. So net change in cash is zero because the company raised exactly the amount of cash it needs to pay, which is needed to be paid out for the to the shareholders. So in summary, debt will increase on the balance sheet, equity will decrease, and cash will remain unchanged. And on the cash flow statement, there will be no change in the cash flow from operations or investing, but there will be a change in the cash flow from financing. Inflow by the exact amount and outflow by the exact amount. Inflow in the form of debt and outflow in the form of dividend. And this will cancel each out. So there will be no impact on the net cash. So I hope this is understood. So